Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Jay. It's fantastic to have you back on the podcast show.
Thank you, Bilal. Happy to be here. Happy New Year.
And to you as well. Now, it's a new year, 2025, lots going on in the world, but I think sometimes it's helpful to step away from the day-to-day stuff and think very big picture. And you're fantastic at that with your tripolar framework. So could you just remind us and our listeners what your tripolar framework is? And then we could also talk about some of the key planks of how the tripolar world's intersecting with things like AI, climate, and defense.
Thanks, Bilal. And yes, I think it's one of our kind of real advantages here at TPW Advisory that we have a framework for thinking about the world. As global macro investors, I think having a framework and a process is really critical to being successful. I developed this idea of a tripolar world, so Europe, Asia, and the Americas integrating as regions, and therefore becoming capable of standing kind of on their own as a region, with the idea back in the day of each region being able to self-finance, so development of capital markets, et cetera, self-produce, so again, the idea of being able to produce within the region, not necessarily just within the country, and then self-consume, right? The wealth, the creation, the development of the economies, the development of per capita income sufficient so that you could consume. And so that led us to, the last 5 years or so when COVID really gave us, I think, a serious jolt in this direction, right? The whole idea of, global supply lines, and we need to make our own medicine and all these types of things that came out of COVID. And more recently, we've been really working with the idea of not only regional integration through the three regions, but also regional competition. And so the idea that the three regions are starting to compete in what we very nicely have three categories of AI, climate, and defense. So we really like the number three, right? Maybe that's because that's all I can remember is three things at a time. But the three regions, Europe, so clearly Europe is well integrated with the European Union, but have the problem of not having, common taxation and thus common revenue creation through a bond market, and therefore problems of really leveraging its heft. That, in our view, that's Europe's biggest problem. It still kind of punches not at its full weight of a 500-600 million person region with an $18 trillion economy. It's still punching well below that. And that's a problem, as we see in Europe, and we can talk about it in more detail. Asia, we see really kind of integrating around China, right? If you spend any time in Asia the last 10 years, you know that China is such a big economic engine that there's no way that it's not going to draw the other countries in the region closer together economically. And that was first as kind of a marketplace, right? People wanting to sell into China. And now increasingly it's China being the biggest FDI provider as the companies in China go outside to set up offshore production. And so you get to a point where today China exports more to ASEAN than it does to the United States. And so you have clear Asian integration. And then the Americas really, we would argue, have not leveraged the success that the North America integration really created over the, since the mid-90s with NAFTA, right, where Canada, the US, and Mexico kind of came together. Back in the day, we had the concept of Canada being the natural resource provider, US being the consumer base, and Mexico being the low-cost production center. That has kind of still worked as a thesis, as a way of thinking about it, but the Americas have not dropped down into South America to leverage what's happening there. And as a result, you have China becoming the biggest trade partner for Mexico, or sorry, for Brazil, for Argentina, You have Europe now integrating with Mercosur through the most recent trade agreement, while the US kind of doesn't really engage fully and sees it as a problem, obviously, through the lens of immigration, border control, et cetera. So that's been the US focus, as opposed to let's leverage all those people, all that low-cost production capacity, and all that mineral wealth, and really drive the Americas to compete with China and Europe. So today, just to kind of wrap this up, right, we're really leveraging two themes that we see coming together in a very interesting way. So the first is this tripolar world, right, of regional competition in AI, in climate, in defense. We believe that this competition requires what we call the new industrial policy, and that is fiscal and monetary policy working together to provide the funding and the expertise through the private sector to be competitive in AI, climate, and defense. Okay, so that spending, that participation of public and private, that participation in the private sector and the public sector, monetary and fiscal policy, drive growth through that spending vehicle. Okay, so that's the first theme: competition driving spending, really leveraging who has fiscal space, who has good governance to actually drive fiscal and monetary policy in public and private partnerships to produce world-class AI, climate mitigation, defense. And then the second side is what we call our long cycle. So our 2025 outlook, which we publish now in November, we like to get ours out early, so we have our own thinking as opposed to just regurgitating, everybody else's 2025 outlook. Our outlook was titled The Long Cycle. And our thesis is that we are early in a complementary global growth cycle fueled by the spending we just talked about to compete in the three areas, in the three regions, through the earnings channel, driving a global equity bull market. All right. And so that long cycle, we argue, is 2023 through like 2027 and perhaps beyond to the end of the decade. So we're kind of early to mid in our long cycle thesis.
So you're definitely not in the late cycle camp that we're going to see a massive correction this year. I mean, some people are saying, we had 20% plus returns in the US last year, so we have to have a large correction this year. So I guess number one, when you say the equity long cycle, are we talking about a global equity long cycle or a US equity long cycle? And you titled your recent piece US Exceptionalism at Risk. So how do you kind of put the regions together in that context?
Sure. Yes, no, definitely global equity bull market, global growth cycle, right? And so the US has been the clear leader in the growth side post-COVID, without a doubt. I mean, President Biden got no credit for it politically, but economically speaking, the US, our way of thinking about it is that China kind of led this new industrial policy through its spending on the climate front in renewables. And as a result, now dominates the entire climate space, right? The US responded with the CHIPS Act, Infrastructure Act, Inflation Reduction Act to become competitive in those spaces. And that generated tremendous private sector investment as well as public spending. And now we have a big, fiscal deficit. Europe is really kind of still trying to figure it out and getting exposed through things like the stagnation in Germany, what's happening in the auto sector, again, in Germany, the question about fiscal space in the UK, fiscal space in France, et cetera. So definitely thinking that the US has been the leader in the growth cycle, also the leader in the equity cycle, right? Since the great financial crisis, the US only game in town, without a doubt. So where does that leave us today in thinking about 2025 and thinking forward? So we're focused on the idea that the incoming administration is probably going to be less successful at policy execution, and we can talk about why we think that is. And as a result, that ties in with what is typically a year 3 bull market type return, right? So our view is that the bull market started in 2023. It's 2 years old, and typically bull markets last 5 to 6 years. This one's returned 70% or so. Typically, the full return over the 5 to 6 years is about 200%. So that kind of times us in terms of where we are in the equity market, bull cycle. Okay, global growth, we wrote in our 2024 outlook, which was titled Surprise, Surprise, written in the fall of 2023, that we were early cycle, not late. That was the fourth surprise. We had 4 macro surprises. The fourth one was early cycle, not late. And we continue to feel we're early cycle, again, 2023 through 2027. And we would note that today, what really gives us that confidence is that we see commodities breaking out. Not breaking down, breaking out. And commodities breaking out supports this idea of this spending in each region driving global growth, and through the earnings channel driving a global equity bull market. And we see the opportunity set more outside the US than inside the US. The US fully priced. Foreigners have never owned more. The dollar is very expensive against virtually any pair you want to compare it to. And we think there's going to be difficulties in executing the Trump agenda. On the other side, when we think about who has the fiscal space to do the spending necessary to compete, Germany jumps right to the top of the queue in having an election next month. We think that election is going to be very important. We think it's going to unlock the debt brake, and we think Germany is going to stimulate pretty aggressively. China is another country that, from a central government perspective, has considerable room to leverage its fiscal space. And we believe they are going to continue to do that. And so we look at the current environment as one where the US is priced for perfection at a time when the incoming administration is likely to be anything but perfect. And again, we can talk about that. Versus the rest of the world, which is priced for the opposite of perfection, right? You have record valuation premiums in the US versus EM, 50-year wide premium valuation versus DM, ex-US, same thing. You have a dollar that's massively overvalued. So all the money has migrated to the US. And we think if we're talking about reshoring of production, reshoring of jobs, how far are we from repatriating capital? And if we start to repatriate capital, if Germany, Japan, China says, hey, folks, we need to bring capital back to help fund our efforts on AI, our efforts in climate, our efforts in defense, where's that money going to come from? And so to us, that's really the opportunity and the setup that we think is going to unfold over the next couple of the years. And so the US has been the engine, the go-to place, game has been played, rest of the world, more space to stimulate, more process to go, more growth to come, undervalued, underowned opportunity.
And on the US specifically, you know, one feels like one could almost make the same argument every year for the last 2-3 years, that the US always seemed expensive. It always seemed like it was, you know, too strong relative to the rest of the world. So, I mean, why now do you think, you know, the US will do less well compared to the rest of the world? What is it about now versus a year ago?
Yeah,
say?
Perfect. Yeah, absolutely right. 100% Bilal, right? I mean, the trend is the trend. The trend has been strong. It's been a mistake to go against that trend, and we recognize that, and we respect it. And we are invested in US equities, don't get me wrong, right? But we do think there are a couple of catalysts that could stimulate a change, right? And it's not valuation, right? Because again, we know, you and I have been in the game a long time. Valuation is not a good timing indicator, right? But what is earnings growth and multiple expansion, right? And the potential for multiple expansion. So when we look at the US, one of the things that really fuels our outlook is the historical fact that year 3 of equity bull markets tends to be a rest year, tends to be a single-digit return year. And so we have a chart in our monthly. By the way, we have 34 charts in our monthly, and some of them are really, really compelling. I encourage your audience to go to our website and check out the monthly. But one of the charts shows that the average year 3 return for U.S. bull markets is roughly 3%. Okay,
oh, wow.
so
it's
we're expecting single-digit type returns for the U.S. equity market this year, and that's driven principally by earnings growth, right? I think we can say that the likelihood of the U.S. having multiple expansion is pretty unlikely. So now you're talking about earnings growth, and earnings growth for consensus for 2025 is double digit, but we again know that typically analysts are optimistic and they bring it down over the course of the year. So let's call it 7%. You know, who knows? But we're expecting something like that. History suggests that, economy suggests that, where we sit today suggests that. And at the same time, we think you can argue that the rest of the world has earnings growth similar to the US, if not better, right? Consensus, again, is roughly 10 to 12% for non-US. Some are forecasting emerging market earnings growth to be better than the US, but let's call it roughly the same, single digit, high single digit earnings type growth, right? We are assuming that Germany is going to stimulate and grow their economy. We are assuming that China is going to continue to stimulate and will grow its economy at roughly the same pace as it is today. And so we are suggesting that you have earnings growth plus room for multiple expansion in the rest of the world, leading us to single-digit returns in the US, double-digit returns in the ex-US, with potential for that double-digit ex-US return to be augmented by dollar weakness, right? Dollar strength has flattered the US returns for non-US investors, right? Tremendously over the last couple of years. We think that starts to go in reverse and flatters the non-US investor as we move forward.
Yeah.
And so to us, it makes sense because, again, you and I have been in the game a long time. We know when the US is up 20%, nobody cares about the rest of the world. When the US is down 15%, everyone sells whatever they have outside the US. So this setup that we're talking about is actually pretty much the best setup possible for non-US equity outperformance.
Now, I have to ask you about Trump, but maybe before we get to Trump, let's think about Republican administrations. I mean, there's a general perception that Republican administrations tend to be good for stocks because they're deregulation, they're more corporate friendly. And there's also this notion that there's an election cycle as well. Like the first year after an election, often returns are quite good from my sort of understanding. So how do you address those 2 points? First, Republicans are good for stocks, and second, the first year of a presidential cycle tends to be good.
Well, one of the things that one thinks of is the realization that Republican presidents in their first year, with the exception of one in recent memory, George H.W. Bush, so Bush the first, not Bush the second, every Republican president starts out their term with massive unfunded tax cuts. And that tends to stimulate the economy. This president is not going to be able to do that because he is starting with a fiscal deficit of 6% of GDP. And the bond market has already arguably suggested in the last month or so that there's no appetite for that type of spending. So that's one point we think about. The second is that the Trump team is riven with disagreements about different policies, right? If you go back 2 or 3 years, you can find a different policy take for virtually every person that is likely to be responsible for policy. The third point we would make is that, many, and this is not really true of the economic policy team, but certainly in places like defense, intelligence, health, and law, the incoming president has nominated very, very unqualified people. And so this is part of our issue. The US is in a major competitive world, and it has the hubris to nominate deeply unserious people to positions of serious power. And how that plays out, we will see, but we don't think it's going to be very, very good.
Yeah. Actually, on that point, actually, I had another guest who was more on the Republican side, about giving kind of more favorable view on the Republican side. His view on the candidates was that maybe the top level cabinet minister, may not be qualified, but they will appoint their number two guy to be very qualified. So there's kind of the front man who will be almost like the PR person, but then the next level below will be more technically stronger and so on. Do you think something like that could materialize or not? I mean, I'm just trying to present like a potential optimistic scenario here.
Sure. No.
Okay.
No. So the other point that we would make is that so you start off with a massive fiscal deficit with deeply unserious people who hold widely divergent views at a time when you have a very bare bones Republican majority in Congress. And this is why I say no to the idea that, the underlings can make it all work. Because the vast majority of this has to pass through Congress, right? Has legislation. And again, we have a beautiful chart in the monthly. This administration takes office with one of the smallest majorities in modern American history. So the likelihood of the tax cuts getting done further or extended, right? The idea is to extend the first Trump administration's tax cuts, which are coming up and need by the end of this year to either be renewed and extended or they expire, right? Which will act as a tax hike on the wealthy, certainly, who were the biggest beneficiaries of the Trump tax cut. And that has to be done through legislation. So the extremely narrow Republican majority really suggests to us kind of inaction and problems of execution. And that's what we expect, right? We look at, Scott Bessent, the likely US Treasury Secretary. Hey, he's a global macro guy, right? That's great. I mean, as a global macro guy myself, it's wonderful to have a hedge fund manager as the Secretary of the Treasury. I don't know if that's ever happened before. I don't know how a hedge fund manager trained to think in months and quarters actually is going to be able to think about long-term strategy of what's best for the country. I question his three arrows, right, which he's taken from former Japanese Prime Minister Abe, 3% growth. Well, okay, we're already there. Q4 Atlanta Fed nowcast for GDP for Q4 is 3%. We're already at 3%, but he's proposing to cut the deficit from 6 to 3 while maintaining 3% growth. That part is really challenging to me. I don't really see how that works. And then 3 million barrels of new fossil fuel production on top of the already record-breaking, world-beating, biggest energy producer in the world, United States. And when you go beyond that soundbite and actually read and listen to what oil executives and natural gas executives say, they say not happening because they need oil prices to be where they are or higher to generate returns to if they have to invest further. So, I respect Mr. Bessent, but I think it's going to be really difficult to have those three arrows fly, much as Prime Minister Abe found them very difficult, right? They
Yeah.
didn't actually have success.
And just on the execution side, I mean, the Trump one administration was very chaotic. I mean, it was really unclear from a market's or anyone's perspective what policy would be. And you could definitely see there was some kind of policy premium that had to be priced into US assets. This time around, I mean, do you think he'll be more organized this time around? Because, he's already been the president once before. Is there anything you're seeing in Trump 2.0 or anything he's done or said over the last couple of months that makes you think, okay, there will be some differences, good or bad, in Trump 2.0?
Yes. And to me, it's pretty much squarely on the bad.
Okay.
And so we talked about unqualified nominees for critical positions of power. We talked about policy disagreements within the team. Again, you can find virtually both sides, 3 sides, 4 sides to any argument from the same people over the last couple of years. So these are no like true believers, right? These are people who have proven that they're willing to say virtually whatever Trump wants them to say. That's basically where we're at, sadly, in America. Furthermore, there's no elder statesman. These are all true believers, right? In Trump 1.0, because he was unproven, he had to surround himself with elder statesmen, right? You think of his chiefs of staff, you think of the defense ministers, right? Look at the nominee for defense minister today and compare them to the defense secretaries, not ministers, of the first Trump administration, right? End of story. Same with the intelligence, same with health. This is the point. Unqualified, unserious people in positions of serious power, particularly in an environment of conflict and AI and climate where things are very much at risk. Finally, and perhaps most importantly, or 2 more points, no legal guardrails. All the legal guardrails have been removed. Presidential immunity for any act while in power. Immunity. And then no need to run for re-election. So I find those things put together to be very, very worrisome, frankly.
Yep. And that adds to the case of US exceptionalism being at risk.
And I would just finish to make the point that I believe, and I write in the monthly, that we're at peak Trump vibes right now, right? This past weekend, with the launch of the Trump coin and the Melania coin and all the other BS, is peak Trump, in my view. And going forward is actual governance. And as I've tried to suggest, 6% budget deficits, a bare bones majority, an unproven cabinet, a competition in AI, in climate, in defense, with serious players in Asia and China, and serious players potentially in Europe, should they get their act together. Strikes me as, we think it's only going to get harder for Trump going forward.
Yeah. Now, on the rest of the world, investors across the board are fairly pessimistic on Europe. I mean, every investor I speak to just think Europe is just over. And part of that is to do with, Germany's whole economic model. So in essence, they imported cheap Russian energy, made cars and sold it to the Chinese. Now, all parts of that have broken down. And so there's this general, structural bearishness towards Europe. You seem to be presenting more of a positive case. It's almost contrarian almost to what most investors are thinking. So could you talk a bit more about the European story, say, and this issue with Germany in particular?
Yeah, I mean, I think it really does hinge on Germany, at least the way we're looking at it. I would remind investors that much with China, right, the story about China is uninvestable, right? Yet large cap China, as represented by the ETF FXI here in the US, outperformed the S&P last year. Outperformed the S&P.
I didn't know that.
China. Okay, that's a fact. That's a fact. You can look it up. All right. Similarly, with Europe, Germany, the German stock market had a great year. German stock market is record highs. Why is that? Well, it's because there are even still today good companies in Germany that aren't dependent on the German economy. And so you have SAP, you have Siemens, you have multiple companies. But that's kind of just making the point. What we expect.
Great points, actually. I mean,
Yeah.
sometimes we get a bit too caught up with the economic headlines and forget actually asset market performance.
Yeah, and again, China, again, you and I know very well, right? The idea of stocks and GDP growth being correlated, China is the poster child to prove that that's not the point.
Yeah.
Not the case, right? 10% GDP growth for years and the stock market did nothing. So again, you and I know this, but I just make these points because, as you know, Bilal, right? Today the media is just, the media is just like all one thing, all one way, all the time. And that's why I said uninvestable, yet outperforms the S&P. That's classic to me. And I like that kind of stuff. We like that kind of stuff here at TPW Advisory. And we're happy to say we had a position in Chinese equities for the entirety of 2024. And we have a position today, and we're keeping that position. And so Europe. Basically, our view is that Europe is lagging behind in the tripolar world, right? Not really competitive in AI, right? Germany trying to do a deal with Intel. Intel maybe not the best choice of partner. That's struggling. Climate, okay, next gen EU spending is percolating through the system, is helping the periphery more than the core, right? Defense, okay, now we're talking, much as there was joint borrowing for climate, maybe there's going to be joint borrowing for defense. We surmise in the monthly, what happens if there is peace in Ukraine? Is a Ukrainian reconstruction project bullish for European growth? Is peace in Ukraine bullish or bearish for the euro? Is it bullish or bearish for rates in Europe? Right? Europe is going to continue to cut rates. The ECB is going to continue to cut rates. The economy, workforce is fully employed. Currency is cheap. It's tied to consumption in China. We believe that part of what's going to happen in China in the next couple of years is a focus on stimulating domestic consumption. At the margin, that should help Europe. And we believe that this election next month in Germany is going to see the CDU as kind of the leading party with a new chancellor. And the focus is going to be on easing the debt brake so that Germany can stimulate and invest in its economy and kind of recapture some of its mojo. Because right now it's stagnating and it's prime companies, its pride of place European automakers are reeling from the onslaught of Chinese EV competition to the point where they're basically being priced out of the Chinese market, which for companies like Volkswagen was the main market over the last decade. They're becoming increasingly uncompetitive in that market. And now you have Chinese companies, EVs, coming into Europe. And so I think the penny has dropped. We would like to see kind of more action out of the European Commission. We think the team that Ursula von der Leyen has put together is a very strong team, but has not really started to fully engage. It needs to. And so we believe that, President Trump will be a catalyst in this regard again. And importantly, it's a two-stage process, right? In Europe, Germany is going to move, we believe, because it is stagnant. It has to move. And Trump is a catalyst to facilitate that. Similarly in China. China is fighting deflation, not inflation. It needs to stimulate its domestic demand profile for itself, because otherwise it's very exposed to somebody like Trump, given its $1 trillion trade surplus. So it's going to move because it has to, and Trump is a catalyst. And that's the two things we want to make sure we tie together. It's not just Trump and Trump is going to result in all these things. No, Germany is stagnant. It hasn't grown for years. It needs to move. China needs to stimulate its domestic demand profile. It needs to act. It has had tremendous success in the Made in China 2025 thesis, right? Again, we have a beautiful chart in the monthly showing like 10 or 12 key technologies and where China was 10 years ago, where it was 5 years ago, and where it is today in those key technologies. And it is steadily munching its way up the food chain, right? And it's not going to stop. And so, but it needs to stimulate its domestic demand profile unless people just are going to try and wall it off. We've already seen that in the AI space, what we call splinternet. And clearly that's not working.
And how about someone like Japan? We haven't talked much about Japan. I mean, we obviously have the Bank of Japan is likely to hike rates. We're recording this actually before the BOJ meeting, but over the course of this year, they're likely to hike rates. You know, where do you stand on Japan?
Yeah, Japan actually is very, very interesting to us right now because we talk about the need to perhaps repatriate capital. And we think Japan could be the country that starts that process, right? So Japan is the world's largest foreign holder of treasuries, holds $1 trillion in treasuries. China holds about 900 billion. China's been steadily decreasing its holding of treasuries. Japan, 1 trillion, number one. The BOJ, as you point out correctly, we agree, is raising rates. The yield gap between US and Japan is narrowing considerably. The BOJ is going to significantly reduce its ownership of JGBs. Thus, there's going to be a real need for somebody else to come in and buy those JGBs. And at the same time, the prime minister is likely to continue to provide or present stimulus packages to try and continue to drive the Japanese economy. And by the way, Japan also offers something that other countries do as well, which is an increasing focus on ensuring that its stock market is run for investors. So if you look at stock buybacks, if you look at dividends, if you look at M&A policy in Japan, all those things look much more like in the US than they did 5 or 10 years ago. Japanese companies, like Chinese tech companies, are buying back huge amounts of stock, huge amounts of stock. And so, yes, we think that Japan could be very, very interesting. We have a position in Japanese equities in our global multi-asset model. And we're looking at Japan as possibly the lead dog in the idea of repatriating capital to drive its own domestic economic engine and start the kind of the rollover in the US dollar, which we think is really critical, right? Okay. For us to be right, in our view, that non-US is going to outperform, that emerging markets are going to lead the way, we really need the dollar to weaken. And so again, we go back to commodities, and I know we're getting a little bit off the Japan question, but hopefully we touched on that. The commodities thing is really interesting because commodities are breaking out with US rates going up and the dollar going up. And again, you and I know that's not how it works typically. Stronger dollar does not correlate with stronger commodity prices. So we think there's something going on. All the focus has been on, U.S. equities, the S&P and Mag 7 and blah, blah, blah. Then the focus on the bond vigilantes. At some point, their focus is going to turn to the fact that commodities are breaking out. And we think that's going to be constructive for big parts of the non-U.S. market. Not necessarily Japan, because obviously it's not a commodity producer, but we do think that Japan could be, the yen could be like one of the stronger currencies. And again, that idea of dollar strength flattering non-dollar holders' returns could flip to the point where yen strength could flatter US-based investors and domestic investors in their return profiles.
And so just to kind of sort of summarize the views here, so US equities will underperform the rest of the world, single-digit returns. Rest of the world, both DM and EM are likely to have a good year on the equity side. Within the rest of the world, do you have a preference, or is it kind of fairly equally balanced between all of them in terms of your asset allocation?
Yeah, well, just to kind of go through that a bit, right?
Yeah.
Our global multi-asset model is benchmarked to 50% equity, 40% Barclays Global Ag, and 10% Goldman Sachs Commodity Index. We are right now about 70% equity, 10% fixed income, and 20% commodities. Fully invested, no cash. Have not had any cash for a long time, over a year. And so double weight in commodities and massively underweight fixed income.
Yeah.
Right. Our view is that, as we tried to say, in this tripolar world competition, new industrial policy, the huge amount of money required to be competitive in AI, to spend on climate mitigation, to be solid in defense, means fiscal spending. And that's why we're talking about who has fiscal space. And the people who have fiscal space are Germany and China. What markets do people not like? China and Europe. That to us is an opportunity. So we are overweight EM, expressed primarily through China, but not exclusively. So overweight China, overweight EM, kind of market weight in non-US DM. So, as an illustration, and very underweight fixed income, zero sovereign bond exposure. We have not had any sovereign bond exposure in our global multi-asset model for well over a year, zero weighted treasuries. We have US credit and EM credit. Credit's going to be fine because the economy is going to be fine for the reasons we discussed. And then in commodities, we have a double weight expressed across the spectrum: energy, industrial metals. So think of copper miners, think of uranium, think of precious metals and the gold miners. We have a position there, and positions in energy. We're big believers in AI and the nexus of AI and power to drive all the compute. And so we have positions in things like the electric grid and infrastructure, et cetera. So, we have a couple of big themes that we're participating in. We have that broad view of equities outperforming the rest of the asset classes, non-US equities outperforming US, fixed income, sovereign, very unattractive, and commodities quite attractive.
Okay, no, that's a fantastic overview there. Now, I did want to end with a non-markets question. I know you're into your sports, and as a European, I don't know enough about playoffs, but I understand there's playoffs at the moment in football, in American football at the moment. How's that going for you?
Well, it's kind of like my political, prognostications, Bilal. So I was pretty clear in my view that the Democrats and Kamala Harris would win the presidency, and obviously was wrong on that. And had to go before the audience on Bloomberg and do a mea culpa. And so playoff football, yes, I love American football, and I think it's very interesting, kind of the challenges of, particularly in playoffs, like your best player against the other team's worst player, and how do you make those matchups happen so that you can, be successful. And I find it's very, I actually use in the monthly, that's my intro to the whole piece, saying that it's similar in the policy makers today. So which policy makers in the US, in Europe, and in China in particular are going to be successful? And this is why I focus in on the fact that, for a lot of the major positions in the US, these are not the best people. And that's just a fact. And so I don't really see how that can be successful in a very competitive world. And so I kind of draw that analogy. But having said that, the two teams that I thought would make it in the Super Bowl both lost this past weekend, the Detroit Lions and the Baltimore Ravens. So I think, we're narrowing it down from don't know politics, don't really know sports, can talk about it. So hopefully I know something about markets and investing. Otherwise, I may be in trouble. And I want to end on this note, because as I did in the monthly, not to mix the sports metaphors, right? But we want to skate to where the puck is going, right? Think about hockey, not where the puck is, right? The puck is in the U.S., right? U.S. assets, most expensive, most owned, all that stuff. We want to skate to where the puck is going. And we think it's going because it needs to for Germany and for China, and because it's going to be stimulated and catalyzed by Trump coming into office. We want to skate to where the puck is going. And we think that's non-U.S., and we think that's commodities. And we want to be really careful about fixed income exposure because it's an expensive game, right? Pro football, professional soccer, you name it, it's an expensive game. And so fiscal space is going to be at a premium. And what we think is really interesting is that the countries with fiscal space are trading at massive discounts. And that is where we want to skate to.
Great, that's fantastic. Now, a final question for our audience. What's the best way for them to learn about you and see your work?
Yes, indeed. Thank you for asking. So we are TPW Advisory, an independent investment strategy boutique. We're based in New York, where I've been for 40 years, give or take now. And you can find us at Pelosky.com, Pelosky, Pelosky, my last name, .com. And we have a nice website that shows our recent work, talks about our models. We talked about our global multi-asset model here a couple of times. We also have a TPW 20 thematic model where we focus on future tech and climate. Those are the two models that we offer. You can reach out to learn more about that process. And we welcome any incoming calls or questions about our work. And always, as I said at the top, Bilal, thank you for the opportunity here. It's great. You always have great questions, and you always throw in the little thing about the sports. I remember that from the last time, so I appreciate that. And wish you and your audience at Macro Hive all the best investing and personally in 2025.
Great, likewise. Thank you. Thank you very much. Thanks, Jay. Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.